You ever stare at a single candle on your chart and feel like it's trying to tell you something? Not with indicators, not with Fibonacci levels, not with moving averages or volume profiles. Just that one candle. It's open, it's close, it's high, it's low, the raw space it covers. Because inside that tiny rectangle of light and shadow lies the entire psychology of the market. Every heartbeat, every emotion, every flash of greed, and every moment of fear. Each candle is a conversation between buyers and sellers, and inside that conversation lies something most traders never learn to hear: intent. Candle range theory, or CRT, is all about uncovering that intent. CRT isn't about guessing where price might go next. It's about understanding what the market is doing right now. It's about clarity, not prediction. It's about peeling away all the noise, the indicators, the overlays, the colorful distractions, and listening to the only thing that truly speaks in the market: price itself. Because when you start reading price through the lens of candle range theory, you stop seeing random candles and start seeing the energy behind them. Each candle becomes a story, not of buyers or sellers, but of pressure, of who's in control, who's fading, who's exhausted, and who's about to make a move. Every trader at some point hits a wall. You try every indicator under the sun: RSI, MACD, Fibonacci, Bollinger Bands. You watch 50 YouTubers read endless Reddit threads by that one secret strategy course that promised everything. And yet, the market keeps humbling you. You make progress, and then you give it all back. You start doubting the entire idea of consistency. But the truth is, what you're missing isn't a better indicator, it's understanding. The kind of understanding that comes from seeing how markets actually breathe. Because price doesn't move randomly. It expands, it contracts, it compresses, it explodes, it breathes. And candle range theory is the art of reading that breath in real time. So what exactly is candle range theory? At its core, it's a framework for reading the strength and intention behind every candle. Instead of focusing on whether a candle is green or red, CRT focuses on how much distance it travels, its range. That distance between high and low is the pulse of the market. It's how much fuel was burned in that moment, how much energy the market exerted to move from one point to another. A small range means compression. Traders are cautious, orders are building, energy is storing up. A wide range means expansion, volatility, aggression, release of built-up tension. Markets move in these alternating cycles of compression and expansion. And understanding that rhythm is like learning to surf waves instead of fighting the ocean. When you strip away the colors, indicators, and fancy names, every market move boils down to this: periods of stillness and periods of violence. The stillness is where liquidity builds. The violence is where it gets released. Candle range theory gives you the lens to detect those transitions before they become obvious to the crowd. It helps you see when the market is inhaling, compressing ranges, quiet before the storm, and when it's exhaling, exploding ranges, liquidity swept, trend ready to form. This isn't guesswork. It's the natural behavior of all markets, whether it's forex, crypto, stocks, or commodities. Because at the end of the day, all of them are driven by human behavior, and humans move in patterns of tension and release. But before you can master CRT, you need to understand where it came from and why it even exists. Candle range theory wasn't invented in a corporate lab or a trading algorithm department. It was born on the charts by traders who watch the markets every single day, manually marking highs and lows, tracking candle behavior over thousands of hours. They started noticing something strange. Not all big candles mattered, and not all small candles were meaningless. Some small candles controlled massive future moves. Some large impulsive candles that looked powerful on the surface ended up being traps. The difference wasn't in their direction or their color, it was in their range behavior. That discovery changed everything. They realized that a candle's range, the high-low distance, wasn't just a measure of volatility. It was a measure of effort. The effort required for price to move within that bar. Wide ranges meant the market spent a lot of energy. Someone pushed hard. When you see a wide candle, it's like watching the market scream. It's not a casual move, it's a statement. That kind of expansion doesn't happen without effort. It's the moment when one side, buyers or sellers, goes all in, dumping capital, conviction, and emotion into the move. The market doesn't expand its range unless someone forces it to. Think of it like a boxer throwing a heavy punch. It takes energy, and that energy leaves a trace. Exhaustion, follow-through, or reversal. Wide ranges reveal aggression. They tell you where someone made their stand. They expose the moment the market said, "I'm choosing a direction." But here's the key. Wide ranges are unsustainable. Just like a sprint, that burst of power can't last forever. After the expansion, you look for signs of fatigue, wicks showing rejection, smaller follow-up candles showing hesitation. That's where you can read whether the move had real intent behind it, or if it was just noise, just a desperate attempt to trigger stops before fading away. Every wide candle is an emotional outburst, a footprint of imbalance. When you learn to decode it, you're no longer surprised by what comes next. You expect the aftermath of that energy release, and that's how you get ahead of 90% of traders reacting to it in real time. Narrow ranges meant tension. Energy was being stored. Now, on the opposite side of that spectrum lies silence. Those small, tight candles that seem to go nowhere. Most traders ignore them, but in reality, that's where the magic brews. Narrow ranges are the market's deep breath before the scream. It's the compression of energy, price coiling, volume drying up, volatility shrinking. All signs that something is about to happen. The market can't stay quiet forever. That contraction of range is the buildup of imbalance waiting to explode. Imagine holding a spring between your fingers. The tighter you compress it, the more force it'll release once you let go. That's exactly what narrow ranges represent. Potential energy. They're not weak, they're patient. They tell you that the market is undecided, but tension is mounting. And once a candle finally breaks out of that narrow pattern with range expansion, that's the signal the energy has been released. Smart traders don't chase that breakout. They study the compression that came before it, because that's where control was established. Narrow ranges are not noise. They're whispers of a next wave forming beneath the surface. And if you can recognize that tension early, you can position yourself before the storm, while everyone else is still waiting for confirmation. A continuation range means genuine strength. The market expanded and is ready to keep going. When you see a candle expand its range and then hold that expansion, that's real intent. That's not noise, not manipulation, not games. That's strength. The market has absorbed whatever resistance was in its path, burned through the opposite orders, and kept pushing with conviction. You'll notice it when price closes near the high of a bullish candle or near the low of a bearish one. It means the winning side didn't just attack, they secured territory. Continuation ranges are what professional traders watch for. They tell you, the market isn't done yet. The energy that created that expansion isn't exhausted. It's building momentum. The psychology here is simple. Smart money doesn't throw all its weight at once. They build positions as the range expands, scaling into the move as confirmation builds. That's why continuation ranges often lead to measured moves, because behind them is structure, accumulation, and intent. When you learn to spot these ranges, you stop being the trader who doubts every breakout and start being the one who rides the wave while others hesitate. A displacement range means manipulation, liquidity grabbed, energy dumped, and a reversal likely coming. But then there's the other kind of range, the one that looks powerful on the surface, wide, aggressive, emotional, but beneath it lies nothing but deception. That's a displacement range. It's the market's favorite trap. It's when the price violently expands, sweeps liquidity sitting above or below key levels, and then reverses like nothing ever happened. The move wasn't strength, it was extraction. Smart money uses displacement ranges to feed off emotion. Retail traders see that sudden burst of range and think, this is the breakout. They pile in, and that's exactly what the big players wanted. Because when everyone buys into that fake expansion, liquidity floods in. Once the orders are filled, the professionals pull the plug. Price snaps back. Energy reverses. The same wide candle that looked like power now becomes a marker of exhaustion, a tell that the market has just completed its hunt. Displacement ranges are emotional manipulation turned into market structure. Learn to recognize them, and you'll stop being the liquidity and start trading with it. Let's imagine another scenario. Euro USD on the 1-hour chart. The market has been consolidating in a tight 25 pip range for 6 hours. Traders are waiting. Then a huge bullish candle prints, 60 pips in 1 hour, breaking the range high. Everyone cheers. Breakout. But the next candle? It's a tiny 15 pip range that closes inside the previous candle's body. CRT instantly flags this as a displacement range, not genuine expansion. It means that breakout was likely a stop run. And sure enough, the next few candles collapse, taking out the other side of the range. Liquidity grabbed, smart money repositioned, retail destroyed. That's the clarity CRT gives you. Without it, you'd be the one buying the fake out. With it, you're the one waiting for the trap to spring and profiting from the reaction. Candle range theory teaches patience because it's built on truth. Markets are never random. They're structured chaos, driven by rhythm. You learn to recognize that rhythm candle by candle, range by range, until the chaos starts to feel familiar, predictable, almost poetic. And once you reach that level of perception, trading stops feeling like gambling. It starts feeling like listening. Because the market has always been talking, most traders just never learn the language.